You know, if you ever open up the back of a like a luxury mechanical watch, you kind of expect to see this beautiful, predictable rhythm.
Right.
Like the gears are turning smoothly, the springs are coiled just right, and everything is engineered for absolute precision.
Okay.
But I mean, if you were to look at the financial plumbing of the markets over this past reporting period, it would look like someone literally opened that watch, threw in a handful of sand, and just they tried to replace the brass gears with digital ones while the watch was still ticking.
Oh, yeah. I mean, it's a completely chaotic transition. We are basically watching this messy, real-time migration of global financial infrastructure.
Yeah.
And the old systems are just grinding against the new systems, and that friction is creating some extreme structural volatility.
And that friction is exactly what we're getting into today. So, welcome to the week that was. We are so glad you're joining us.
Glad to be here.
If you're new here, our mission for this deep dive is pretty straightforward. We basically take a stack of complex market reports, institutional filings, macro data, and we extract the signal from the noise.
Right. Getting right to the point.
Exactly. We leave the sensationalism at the door and just give you the analytical shortcuts you need to actually understand the mechanics of what's moving these markets.
And man, this reporting period has given us just an incredible amount of raw data to process.
To say the least, I mean, we are looking at a highly volatile window where programmatic market sweeps just completely collided with massive macroeconomic policy shifts.
Huge shifts.
Yeah, and we've got corporate treasuries completely fracturing their core strategies, and a historic milestone where literal Wall Street equities launched natively on-chain. Okay, let's unpack this.
Let's do it.
Starting with the sheer mechanical pressure we saw early on, we watched Bitcoin get dragged below that psychological $60,000 threshold, ultimately bottoming out just under $58,900. But looking at the trading volume, this wasn't just, organic panic selling.
Oh, no. Far from it. What you saw was a classic, heavily engineered liquidity sweep.
Okay.
So when organic passive bids dry up in the order books, meaning everyday buyers are just kind of sitting on their hands, the algorithmic high-frequency trading platforms, well, they go on the offensive.
Wait, how so? Like, what are they actually doing when they, go on the offensive?
They are actively hunting for localized stop-loss clusters.
Okay.
Think about human psychology, right?
Yeah.
A retail trader might buy Bitcoin at $61,000 and set an automated rule on their account that says, if the price drops to $59,900, sell my position immediately to stop my losses.
Right, because humans love round numbers, so thousands of these automated sell orders just get clustered around those psychological thresholds.
Exactly. And the algorithms know this. So they start aggressively shorting the market, deliberately driving the price down just to trigger that first cluster.
Wow. And once that first cluster triggers, I mean, it just unleashes a wave of automatic sell orders, which drives the price down even further, right? Hitting the next cluster and the next.
That's the mechanism. It forces margin calls, which forces automated liquidations by the exchanges. It is a highly mechanical, programmatic way of basically flushing weak leverage out of the system.
But, I mean, those algorithms couldn't do that in a vacuum. Like, the algorithmic weakness didn't just manifest out of nowhere.
No.
There had to be a massive fundamental driver providing the downward gravity for this drop to even begin with.
Yeah, and the gravity came directly from the traditional financial architecture. We saw massive capital flight from U.S. spot Bitcoin ETFs.
Just huge numbers, right?
Oh, yeah. Over the previous month, these institutional funds saw about $4.1 billion in net outflows. BlackRock's IBIT fund alone shed roughly $3 billion of that total.
I really want to pause here and explain how this works because the mechanics are just fascinating. This isn't just money leaving a spreadsheet.
No, it's not.
Because of a very specific structural rule the SEC put in place, these outflows create a brutal feedback loop for the spot price.
Right, the cash redemption mechanism.
Yeah.
When the SEC approved these ETFs, they mandated that the funds cannot operate with in-kind redemptions.
Meaning the authorized participants, like the big banks managing the fund flows, they can't just hand physical Bitcoin back to departing investors.
Exactly.
So it's kind of like a row of dominoes being deliberately tipped by robots, or actually it's like a casino that suddenly changes the rules. When you want to cash out your chips, the cashier doesn't just open the vault and hand you your money.
Right.
Instead, they're forced to take your chips, walk out onto the casino floor, and sell them to other players at whatever price they can get in that exact moment just to pay you back in cash.
That is an excellent way to visualize it. If an institutional allocator gets nervous about the macroeconomy and, clicks sell on their brokerage app, the ETF is forced to sell physical Bitcoin directly into the live spot order books. Yeah, so it converts macroeconomic anxiety into direct mechanical dumping of physical assets onto the open market, regardless of what the underlying asset is actually worth.
I have to push back a little bit here, though. If the price is just being dictated by ETF cash redemptions flooding the market and like high-frequency algorithms hunting stop losses, it makes the market sound entirely artificial right now.
Right.
Meaning, is there any organic retail demand left, or are we just watching financial robots fight each other?
I wouldn't call it artificial, but rather highly reactive to the broader macro environment. If we connect this to the bigger picture, the lack of organic retail demand makes complete sense when you zoom out.
Okay, how so?
Retail and institutional allocators alike are rotating out of zero-yield assets simply because global risk-free rates remain incredibly elevated.
Right. I mean, why take on the volatility of a digital asset when you can park your capital in sovereign debt and get a guaranteed high yield just for sitting still?
Exactly, and those yields are staying high because inflation is proving to be incredibly stubborn. The latest data shows core PCE inflation, which is the Fed's preferred metric firming at around 3.4%.
And headline was even higher.
Yeah, headline PCE hit 4.1%. We are now looking at 63 consecutive months above the Federal Reserve's 2% target.
63 months. That is just a generational overshoot.
It really is. And it forces the central bank to keep monetary policy incredibly tight. They basically cannot lower interest rates until they are certain that inflation is dead.
But because inflation is so stubbornly high, the Federal Reserve is under immense political pressure to cut rates and, provide economic relief. And that political pressure is exactly what makes this week's Supreme Court ruling so pivotal.
Oh, absolutely.
We just saw a fascinating 5-4 ruling in Trump v. Cook. The court permanently blocked the executive branch from firing Federal Reserve Governor Lisa Cook.
This is a phenomenal example of how legal precedent ripples directly into asset valuations. The Supreme Court effectively validated the absolute institutional independence of the central bank.
Right.
And analytically speaking, this ruling paradoxically hurt Bitcoin prices in the short term.
Right, because it completely insulated the Fed from political interference. I mean, if the executive branch could just fire a Fed governor without cause because they refused to cut rates, the market would immediately price in the fear of politically driven currency debasement.
Exactly.
Yeah.
Politicians historically love cheap money, especially during election cycles. But by legally insulating the Fed, the Supreme Court basically removed that fear from the market.
So they don't have to cave to the pressure.
Right. It allowed Fed Chair Kevin Warsh to maintain a highly restrictive, data-dependent stance without having to worry about losing his job. When the market realizes the Fed will hold the line on high rates, it strengthens the U.S. dollar.
And a strong dollar acts as a massive headwind for non-yielding assets like Bitcoin.
Exactly.
But, the narrative didn't stay hawkish for long. As the week progressed, the macro data shifted, and it shifted hard. We got the ADP National Employment Report, and it showed a severe, unexpected slowdown in domestic hiring.
A huge miss.
Yeah. They only added just under 100,000 jobs, completely missing the consensus estimates of 110,000.
And that weak labor data was the crack in the hawkish facade the market was looking for. Fed Chair Warsh was at the ECB forum in Sintra, Portugal, sharing a panel with the heads of the European Central Bank, the Bank of England, and the Bank of Canada.
Right.
Following that weak jobs print, Warsh actively pivoted his rhetoric. He explicitly stated that inflation risks have come down.
Here's where it gets really interesting. The second Warsh made that pivot, real treasury yields dropped. The opportunity cost of holding non-yielding assets fell, and a massive short squeeze erupted in the crypto markets.
The mechanics of this squeeze were just explosive. Remember those high-frequency algorithms that were hunting long positions earlier in the week?
Yeah, the stop-loss hunters.
Right. They instantly flipped their bias.
Yeah.
A short seller borrows an asset they don't own, sells it, and hopes to buy it back cheaper later. But when Warsh spoke and the price started surging, it trapped all those speculators.
Because as the price climbs, their losses become theoretically infinite.
Exactly. And eventually the exchange's risk engine steps in. Over $450 million in leveraged short positions were liquidated.
Wow.
But again, a liquidation isn't just a loss on a spreadsheet. The exchange automatically executes market buy orders to cover those toxic positions. The shorts are literally forced to become buyers.
It's like trying to rush out of a burning building through a single door. Everyone has to buy at the exact same time, which just acts like rocket fuel for the price.
Yeah, and that mechanical buying pressure brought Bitcoin back above $61,000 and eventually pushed it near $62,800. But more importantly, this macro pivot successfully halted a 10-day streak of continuous ETF outflows. The flow completely reversed. We saw Fidelity's FBTC fund absorb roughly $166 million in new capital in a single day.
So the macro weather changed and the algorithmic robots changed their direction. But as we look past the high-frequency trading, there's a structural shift happening at the corporate level that I find absolutely fascinating.
Yeah, the treasury strategies.
Exactly. The famous never sell mandate for corporate treasuries holding digital assets is, well, it's actively fracturing.
The primary example of this fracture is Strategy Inc. They had to file a Form 8K this week to announce a digital credit capital framework.
Which means what exactly?
In plain English, they formally authorized the sale of up to $1.25 billion in physical Bitcoin.
I'm looking at this filing and I'm honestly confused. I thought their entire corporate identity was built on being the ultimate long-term accumulator. What forced their hand to sell over $1 billion worth of their treasury?
Well, they need the liquidity to fund dividend payments and stock repurchases. Ripple CEO Brad Garlinghouse came out highly critical of this move, pointing out the systemic risks of their underlying model.
Because of the leverage.
Exactly. Strategy Inc. utilized heavy variable rate debt to accumulate that Bitcoin. When macro conditions tighten and the cost of servicing that debt rises, that extreme leverage becomes a major liability.
So they are being forced to sell simply to service the mechanics of their own balance sheet. It makes you wonder if these massive corporate accumulators are quietly turning into highly leveraged structural spot sellers rather than long-term holders.
It's a real concern.
But we have to contrast that debt-heavy approach with alternative models.
Mm-hmm.
Strive, for instance, operates with absolute zero debt, and they use their corporate structure to execute one of the most brilliant defensive moves I've seen in a long time.
Oh, the Strive situation is a complete masterclass in market mechanics. They have a vehicle called SATA, and short sellers were aggressively attacking it. The shorts assumed they were perfectly safe because Strive had a $100 issuance cap. The assumption was anytime the price hit $100, Strive would simply print and issue more shares, which would dilute the value and drop the price back down, allowing the short sellers to cover safely.
But Strive didn't print more shares. They simply threatened to completely remove that issuance cap.
Yeah.
By pulling that ceiling away, they essentially told the market, we aren't going to print more shares to bail you out. They pulled the safety net out from under the short sellers, basically trapping them in a room with no exit.
And the resulting borrow rate for those trapped short sellers skyrocketed to 70%. It was a flawless, unleveraged defense of their equity.
And then you have Metaplanet over in Japan taking a completely different, highly analytical route. They are proving you can accumulate without taking on toxic debt by using options premiums.
Yes, rather than borrowing money to buy Bitcoin, they generated roughly $10.95 million in pure revenue by writing covered calls and cash-secured puts.
Okay, for our listeners who might not trade options, let's unpack that simply. Instead of just holding an asset and hoping it goes up, they are essentially selling insurance contracts on the market's volatility.
Right.
They get paid upfront premiums by other traders who are betting on price swings.
That's a great way to frame it. They took that almost $11 million in upfront premium cash and used it to subsidize their own purchases. By doing this, they lowered their effective acquisition cost basis down to roughly 12.09 million yen per coin.
Wow.
They are proving that self-sustaining, unleveraged accumulation models can absolutely thrive if you know how to build the plumbing.
Speaking of plumbing, while the corporates are battling out their treasury strategies, traditional finance is aggressively moving to rewrite the actual settlement layers of the global system. We saw the Open Standard Consortium, which is a heavyweight group including Visa, BlackRock, and Stripe. They launched the OUSD stablecoin natively on the Solana network.
The network choice is interesting, but the revenue model is the real disruption here. Historically, single-issuer stablecoins take your cash, buy treasury bills, and basically keep all the yield generated by those bills for themselves.
Right, it's a huge profit center.
But Open Standard is changing the game. They're distributing those treasury yields directly back to the enterprise members holding the coin.
Which completely undercuts the legacy stablecoin monopoly. The market immediately priced in this threat, causing Circle's equity to drop roughly 13 to 16% on the news.
But the infrastructure changes go so much deeper than just stablecoins.
Yeah.
We are seeing retail equity markets migrate as well. Robinhood launched Robinhood Chain on an Arbitrum layer 2.
Think of a layer 2 like a high-speed carpool lane built on top of the congested main blockchain highway. It allows Robinhood to process transactions with absolute zero gas fees for the user,
Yep.
but it's what they're trading on that carpool lane that matters.
What's fascinating here is they integrated stock tokens, allowing non-US users to trade major equities 24/7, not just during standard Wall Street operating hours. They have completely decoupled equity trading from the physical clock.
Which sets the stage for the ultimate convergence we saw this week. Securitize debuted on the New York Stock Exchange under the ticker SECZ. But they didn't just ring the bell on Wall Street.
No, they didn't.
Simultaneously, at the exact same moment, they issued $266 million in tokenized common stock natively on the Solana and Avalanche blockchains.
The division between traditional equities and blockchain settlement is effectively gone. And at the same time, Ondo Finance partnered with Broadridge to tokenize BlackRock's S&P 500 ETF, the IVV fund, with full proxy voting integrated natively on-chain.
Incredible.
This isn't a pilot program. This is live infrastructure.
And the regulators are finally realizing they have to adapt or get left behind. The SEC's Division of Investment Management made a highly unusual public pivot this week. They essentially conceded that past mistakes were made regarding how they handled crypto ETFs, admitting they damaged industry trust.
Yeah, that was surprising.
Now they are pivoting to an asset-neutral framework.
The term asset neutral is critical here. It means the SEC will no longer judge a filing based on a predetermined bias against the underlying collateral.
Okay.
They will evaluate new financial products based strictly on structural legality and risk disclosures, whether the asset is a traditional bond or a digital token. It signals a massive structural thaw in relations between Wall Street regulators and digital infrastructure providers.
But as the institutional doors in the U.S. seemingly begin to open, the global regulatory perimeter is squeezing incredibly tight. In Europe, the MiCA grandfathering period officially expired this week.
A massive compliance shock.
Huge. 88% of legacy crypto firms are now operating without licenses in the European Union.
Which is forcing an immediate severe contraction. Binance is already restricting services across multiple EU countries just to avoid catastrophic liability.
Wow.
And the European Banking Authority finalized rules allowing them to fine unauthorized stablecoin issuers up to 12.5% of their annual turnover. That isn't a slap on the wrist. That is a margin-destroying existential penalty.
And the transition isn't much smoother domestically. The Clarity Act, which was supposed to harmonize digital asset oversight in the U.S., got completely blocked in the Senate.
Right.
The opposition was spearheaded by the Independent Community Bankers of America. They lobbied hard against provisions that would allow stablecoins to offer yield to retail users.
Because regional banks are terrified. If a stablecoin can offer a 5% yield safely on-chain, local banks fear it will trigger a massive deposit flight, draining capital from traditional checking accounts into digital wallets.
So what does this all mean? We have Wall Street pushing their equities on-chain, regulators throwing up massive compliance roadblocks, and legacy banks actively fighting the transition. It begs the question, as all this traditional value floods into this new plumbing, is the plumbing actually safe to use?
That is the multi-billion-dollar question, because the cybersecurity realities of this transition are severe. Just this week, we saw a $3.1 million front-end supply chain phishing attack on Polymarket.
Let's break down exactly how that happened because it highlights a major blind spot. The underlying blockchain contracts, like the actual vault where the money is stored, they were perfectly safe, right?
Correct. The attackers didn't try to break the cryptographic vault on the blockchain.
Yeah.
That's just too difficult. Instead, they compromised the website's front-end interface. Essentially, they hacked the GPS directions on the bank's front door, so when users tried to interact with the safe smart contract, their transactions were silently routed to a fake malicious teller controlled by the hackers.
So the vulnerability wasn't the blockchain, it was the traditional web infrastructure built on top of it.
Exactly. And at the enterprise level, the threats are expanding just as fast. Security firms found attackers exploiting a vulnerability in the Langflow AI framework.
Oh, wow.
Yeah, they used this flaw to bypass enterprise security firewalls entirely, deploying automated Monero cryptocurrency miners deep inside secure corporate networks. As Wall Street integrates these technologies, the attack surface is expanding exponentially.
So, synthesizing everything we've looked at across all these reports, we are watching a profoundly messy, highly volatile migration. On one hand, you have algorithms hunting stop losses in the crypto markets and Supreme Court rulings dictating Federal Reserve independence and global currency strength.
Right.
And then on the other hand, you have the New York Stock Exchange effectively extending its hours to 24/7 via blockchain tokenization, while corporate treasuries desperately reinvent how they manage their balance sheets.
It is a complete structural overhaul of how value moves globally. But, there's one final looming collision we need to think about, something the market hasn't fully priced in yet.
Which is?
The collision between antiquated tax laws and these new tokenized bearer assets.
Where is the friction going to come from?
Well, think about President Trump's recent proposal to eliminate capital gains taxes on Bitcoin when it's used for everyday payments. That alone is a massive shift in how the IRS classifies digital value.
Definitely.
But the true crisis waiting in the wings involves these tokenized Wall Street equities we just discussed, like SECZ or the tokenized S&P 500 ETF.
Because they trade natively on blockchains now.
Right. Because these are bearer tokens settling on decentralized ledgers, they can easily bypass traditional dividend withholding taxes when they're traded by foreign investors. The legacy tax systems rely on centralized brokers to withhold taxes before the money crosses a border. But these tokens move peer-to-peer.
Yeah, the legacy tax systems simply weren't built to track 24/7 borderless peer-to-peer global stock trading.
Exactly. So how will the IRS and global tax authorities actually enforce the crypto asset reporting framework, also known as CRF? If Apple or BlackRock equities are trading seamlessly across international borders at 3 a.m. on a Saturday, bypassing all traditional brokers, tax authorities are going to be flying completely blind.
Which raises a very provocative question for anyone participating in this new system. Will base layer identity verification become legally mandatory for all blockchain transactions just so governments can enforce tax compliance?
Very possible.
And if the price of tokenizing Wall Street is mandatory identity tracking at the protocol layer, does that guarantee the end of financial anonymity as we know it?
It's the ultimate trade-off between institutional efficiency and personal privacy.
It's a heavy thought to leave on. The gears of that mechanical watch we talked about at the beginning, they're definitely being replaced in real time. But it looks like the new digital gears might come with a tracking device built into every single tooth. Thank you for joining us for the week that was. We hope this deep dive helped clear the noise, and we encourage you to keep questioning the underlying mechanics of this evolving financial landscape. We'll see you next time.